Hi everyone, this is Wall Street Farmer. Today is my special program for Thanksgiving, celebrating 50 years of financial future. In 1972, IMM, a division of CME, launched foreign exchange future. After that, we had equity index future, interest rate future, and option on equity, option on commodity. In the next 20 minutes, in about 20 slides, I'm going to showcase the important moment in the last half a century. The founding of Chicago Board of Trade in 1848 marked the birth of modern futures industry. In the next 120 years, all futures contracts were based on physical commodity. They were mostly agricultural commodity like egg, butter, potato, onion, live cattle, pork belly, wheat, and cotton. In 1972, chairman of the CME, Leo Malamed, it formed a division called International Monetary Market and launched futures contract on 7 currency pair, ushering a new era of financial future. So wait, CME, was that the exchange that changed pork belly in the 1960s and 1970s? Why would it be the first exchange to launch FX future? Let's look at the background. Bretton Woods system. After World War II, the US and its allies decided on a new monetary system. Basically, the US dollar was pegged to gold at $35 per ounce, and all the other countries pegged their currency to the US dollar at a fixed exchange rate. Each country was responsible for maintaining its exchange rate within up and down 1% of the adopt par value. They do so by buying or selling foreign reserve, and the US was only responsible for maintaining the gold parity, but it's a huge responsibility. Anyone has $35 can go to the treasury window and ask for an ounce of gold. And the US could do that because after World War II, it was estimated US had about 60% of all the gold reserve in the world. Let's look at the exchange rate determined by the Bretton Woods. Japanese yen 360 yuan equal $1. Deutsche Mark 4.2. British pound 0.3571. French francs 3.5 equal $1. Italian lira 625, and the Canadian dollar 0.986 per dollar. So it went very well for about 20 some years. Then in early 1970, we had a Middle East oil crisis, oil embargo, and it triggered huge inflation in the US as well. So President Nixon in 1971 suspended the dollar's conversion into gold. Basically, it said that I'm not going to give you an ounce of gold if you give me $35. That effectively ended the Bretton Woods system. So after that, central banks in the world no longer required to peg their currency at a fixed exchange rate. So we enter an era of floating interest rate that bring new risks for international trade. Before, when you buy and sell and settle in foreign currency, you always know how much local currency you get, you need to have. And now you don't know. So in 1972, Chicago Mercantile Exchange created the International Monetary Market, IMM, led by Leo Maladet. IMM introduced foreign currency future in May 1972. Nobel laureate Milton Friedman was very instrumental in the creation of currency future. Basically, he wrote a paper that won the heart of the government and the New York banker. So when Leo went to see Treasury Secretary of the time, George Shultz, and asked for the approval of currency future, Secretary Xu said, well, I don't know much about forensic future, but if it is good enough for Milton, it is good enough for me. So the original 7 currency pair, 5 of them still are trading actively. They are British pound, Japanese yen, Canadian dollar, Swiss franc, and also Mexican peso. 2 of them, the French franc and Deutsche Mark, they were gone because they bought into the euro currency. Now the second asset class in financial future, interest rate. In 1975, the Chicago Board of Trade created the Ginnie Mae future, which stands for Government National Mortgage Association. It's an agency under the housing department. So basically, this is the futures contract based on the interest rate from the Ginnie Mae bond. In January 1976, CME launched 3-month Treasury bill future, and you see Milton Friedman are the one that launched the ring the open bell. Later, in 1977, Chicago Board of Trade launched Treasury bond future. It was the most successful contract in the history of CBOT. And here is the price trend for the last 30 years of the bond future. And one more contract very important in the world of interest rate is Euro-dollar future. The name is deceiving. It's not the euro currency. It's based on the LIBOR, London Interbank Offer Rate, because at the time, most of the trading of US dollar outside of the US, we call offshore dollar, were traded in euro. That's why it's called euro dollar. And there's a book about that, this one. So there are about 470 pages, all devoted for one contract, euro dollar future and option. And it's actually a lot more than that. It had a lot of really good material on the basic of interest rate and also all the important formula you need to learn about. So here's the euro dollar. And important of the euro dollar is that it's the first cash settled futures contract. Before that, when we talk about the commodity contract, agricultural, energy, metal, they were all required to settle in physical commodity. You buy a cattle contract, so you need to deliver 40,000 pounds of cattle. And also, even on the FX contract, you buy British pound, you actually get British pound. You're not getting just the dollar equivalent. You actually need to get British pound. And before that, the Treasury bond, Treasury bill, and the Ginnie Mae, they will actually require you to deliver in the bond itself. So euro dollar is a different story because it's not a physical commodity and it's not also a piece of paper. It's based on the interest rate on a $1 million time deposit. It's a 3 months interest rate. So if it's a 4% interest rate on a $1 million each 3 months, you get 1%. So basically, that's the interest rate. So you had to be settled by cash. So that become the first cash settled futures contract in the world. The third category of financial future is stock index future. Most people would think the S&P 500 is the first stock index, but it's not. The Kansas City Board of Trade, KCBT, launched Value Line Index Future in February 1982. It was the world's first stock index future, but its lead didn't last very long. 2 months later, the S&P entered the world. So just 5 months after CME launched S&P 500 future, it became the dominant contract in the index future. And it at the end of the year, it captured about 95% of all the volume. Now the last category is option. Before we talk about a contract, we need to know the most important why we had option actually trade on the floor. Black-Scholes Merton, Black-Scholes option pricing model, and you see these three gentlemen, Fisher Black, Marshall, and Robert Merton. I met with these two gentlemen before. Marshall used to be a board member at the CME, and he was the chairman of the Financial Innovation Center under the board. So every 6 months, he come in and then he bring the Nobel Prize winner and all the top economic, and then we had a panel discussion. So I had quite a few opportunity to meet with him, and these two won the 1998 Nobel Prize Economic. Even Fisher is the first name on the formula, but he already passed away at the time. So only Marshall and Robert Merton won the Nobel Prize. And here the formula, I hope you all know by heart by now. And option, there are quite a different kind of option. When the Chicago Board Option Exchange launched in 1973, it was stock option on 16 stock. That's when it started. Now it has thousands of stock. It also has stock index option and the ETF option. But also we had option on future, like the CME mostly option on future. Then it will be similar. You had a stock option future, option on the future contract, and then option on the interest rate future contract, option on FX future contract. Similarly, you can also have option on agricultural future, energy future, and metal future. I was at the Chicago Board Option Exchange a couple months ago. Okay, so we take a look at how financial future perform this day. In the CME, you have the interest rate. You can see the most liquid contract here, euro dollar, 3-month SOFR, which will replace euro dollar as the short-term interest rate contract. The 2-year treasury note, 5-year note, 10-year note, and the treasury bond. In the equity index, we have the E-mini S&P 500, NASDAQ 100, Russell 2000, mini Dow contract, and the Nikkei 225, and also had sector contract on the S&P. And the foreign exchange, we had the euro, British pound, Japanese yen, Swiss franc, Canadian dollar, and Mexico peso. If we look at the volume for the first 9 months of 2022, and you can see interest rate alone account for almost 47% of all the volume. 11 million contract a day, every single trade day. And the equity index is 7.7 million contract, 32%. So these two combined together already like 79% of all the volume. Then the FX account for 4%. Then after that, you see all the financial future and option account for over 83% of all the volume in CME. The traditional agricultural commodity before 1970, 100% was agriculture. Now it's only down to 5.5%. And energy, even we hear about the WTI crude oil, the natural gas all the time, but it's only account for 8.8% of the total volume. The metal, the gold, the copper, altogether account for just 2.2%. So that's the impact. So the financial future really create a lot of opportunity for everyone. And at last, I had a special offering for Thanksgiving holiday. Trend Spider, the only all-in-one toolkit built for technical trader. I use that a lot for my analysis and for all my writing as well. And you can see they had Black Friday special from today, November 19th, all the way to November 27th. All their package, their basic membership, professional member, premium member, you can have up to 45% to 65% off a year. And then they also had another Cyber Monday special offer from 50% off all the way to 65% off. So if you want to get that special rate, and you have to go through this special web link, and then after that, when you basically subscribe to the package, you have to enter my special code JH25. You actually get 25% on top of this. So it's a huge discount, and it can only happen when you do that. So thank you very much, and I will see you next time. Happy holiday, everyone.